This JTS Mortgage Minute is brought to you by JTS and Company Mortgage Professionals.
Good morning, I'm Jeff Farnham. The thought of owning your own place is full of hope and excitement. The actual buying process can sometimes seem scary. I want you to know it doesn't have to be a stressful process that drags on and on. Today I wanted to review some items you should know before applying for a mortgage loan. Knowing this information will make things go much smoother for you when you decide to make the move. Having a low debt-to-income ratio is always a best practice. Debt-to-income is basically the amount of your gross monthly income that goes towards paying your debts, such as credit cards, student loans, car loans, etc. Always pay your bills on time and try to pay more than the minimum. Having a debt-to-income ratio of 40% or less is most beneficial. But there are also loan products available for higher DTI ratios or debt ratios as well. Having steady employment is important, but not always a game changer. Whether you're an astronaut or an auto mechanic, it typically doesn't matter as long as you've had consistent full-time employment without declining income. Gaps in your employment history may need to be explained during the underwriting process. We usually request the last 2 years' W-2s and the past 30 days' pay stubs to verify employment, calculate income, and evaluate your situational stability. Having a good credit score is important as well. When deciding whether or not to do your loan, we need to be sure you have the ability to pay it back. Your credit score is an indicator of risk and is a determining factor in the interest rate you receive. You may ask, what is a good credit score? Loan programs vary, but you will get the better interest rates when your credit scores are 640 and above. If your score is below that, you should still give us a call. We might just be able to help you and review your specific situation. Having a credit card capacity of 30% or less is definitely a best practice. Your credit line is a maximum amount you're allotted on your credit card. Ideally, you want to remain at 30% or less of this total. If you exceed 50% utilization of the maximum credit line available and do not pay the balance down, then this could negatively impact your credit score. We want to help you finance the home of your dreams, so let's talk about how strong your purchasing power is today. Call JTS and Company Mortgage Professionals today. Thank you for joining me today, and have a Merry Christmas, and be sure to tune in next week.
This JTS Mortgage Minute is brought to you by JTS and Company Mortgage Professionals.